Jennifer Markowski. I'm the COO and Marketing Director here at Financial Planning Services, and we're happy to present you the 2024 Midyear Outlook today. We'll be taking questions for the end of the presentation. You can type them into the Q&A box, which you can see on your Zoom control bar there. So now to get things started, I will turn things over to Anthony.
And hello to everyone here. For those unfamiliar with us, we're Financial Planning Services, comprehensive financial planning firm here in Marlton, New Jersey. I'm joined today by two of the other advisors here at our firm, my father and owner of Financial Planning, Ted Massaro, and also Ed Garudo, certified financial planner here with the firm for over 10 plus years. And then myself, Anthony Massaro, certified financial planner as well. Today, we wanted to go through our mid-year outlook in conjunction with LPL's data that they provided to us as well. And where we wanted to start is more on my favorite topic, which is on economics and the economy. So if we can, start with this page here, obviously not prefacing and foreshadowing the most positive events with this title here, economy expected to slow down. But we do want to put some placeholders in and talk a little bit more about what we mean by a slowdown and exactly what that means for the economy and what we see in the future here. Next, if you can here, Jen, really one of the biggest things that we thought was interesting with the economy over the past few years, and something that was really helping to provide a more resilient consumer over the past few years, which has been often overlooked, is the billions of dollars that was tapped into through home equity over the past few years, right? So not only refinancing, which many of us are accustomed to, lowering your mortgage payment with a lower interest rate, but the amount of money that was pulled out through home equity over the past few years, especially in 2021, as you can see, the drastic billions of dollars pulled out during that time frame really helped to spur additional consumer spending. And this is what we relate back to what's called the wealth effect, which the wealth effect simply states that consumers will spend more money as their wealth increases. And we feel that this is one of the major reasons as to why the Federal Reserve's aggressive rate hiking campaign really didn't help to stymie the consumer as much as they may have hoped, which in turn would have slowed down inflation maybe a little bit more quickly. So in these graphs here, you're going to be able to see just exactly what occurred over that time period from 2021 to 2022 and the amount of money that was pulled out from individuals' home equities and allowed them to continue spending. So the refinancing activity and obviously the home equity that was pulled out is shown in these charts. If we go ahead, though, and next here, I think the next chart is going to help us even better understand more about with the rise in interest rates typically. As an economics major myself, we typically say when the Federal Reserve raises interest rates, right, they're slowing the consumer down, trying to, also slow inflation down as well. And why didn't that work as well as it has in past times? And I think really this chart's going to help us understand that even more. We're just not as interest rate sensitive in today's world as we have been in prior decades. And that's shown right through this chart here is that today, we would say about 65% of consumers are homeowners. Now, of that 65%, what percentage even have a mortgage? We would only say about 50% of those homeowners today have a mortgage, right? So if you take out the mortgageless homeowners today, they're not interest rate sensitive whatsoever. In general, they are not having to take out a home equity loan. They're not having to go out, get credit and financing from a different banking institution. And obviously, their largest typical debt has already been paid off. So that already takes, a large cohort of the population off the books and creates a less interest rate sensitive environment. And then you take into account the remaining, let's say 50% of homeowners today with a mortgage. The majority of these homeowners have a mortgage rate under 5%, right? I think it's almost about 70–80% of homeowners today have a mortgage rate under 5%. So with the dramatic rise in interest rates we saw, again, not really impacting the current homeowners, more so those first-time home buyers, people trying to get into the housing market are maybe having a more difficult time. And you're going to see that on the right-hand side, the renters which make up about around 35% of consumers today. But all of this kind of going into the explanation as to why hasn't this rate hiking campaign really caused a more burdensome experience for the consumer? And that's really where we're seeing it, is just because we are not as interest rate sensitive as an economy. If we can go forward here, Jen. So the next page here is really going to exemplify the difference in what we saw. Not only, obviously, I talked about pulling out and extracting equity from clients' homes, getting a big lump sum, cash balance, right, to be able to spend. That's what a lot of clients have been doing over these past few years, and consumers in general. But the refinancing portion of this, right, for clients maybe have had a 6% or 7% interest rate on their home and had the ability to refinance down to a 3.5% interest rate, during 2021, for example. Well, that drastically changed what their mortgage payment looks like. And now suddenly people have $500, $1,000 more per month to spend. Another reason why we're seeing the consumer be much, much more resilient in this economy today is very simply put that they have more money in their pocket, right? Their mortgage costs have gone down, and you're going to be able to see that right through here, that while our consumer debt to service ratio has jumped back up, and it is something that we are watching very closely, especially that credit card debt. We are seeing getting back to those 2008 financial levels. If you look at the mortgage debt service ratio, that's really fallen off a cliff over the past few years due to this low interest rate environment we've been living in. So that's another big benefit to consumers in allowing us to continue to maintain this spending, more resilient spending we've been seeing. I want to talk a little bit about inflation. Jen, if we can go to the next page, we'll talk a little bit more about inflation. That's obviously been top of mind for pretty much anyone that's going out there buying anything in today's economy. So we know costs have gone up, across the board, whether it's, at the grocery store, whether it's your lawn guy, whether it's just going out to eat on a Friday night, right? All costs have gone up across the board. But one positive sign we are seeing is, of course, yes, we are seeing, a lowering inflation environment, decrease in inflation overall. But the more important part of this is we are seeing services inflation, which is going to be much more focused on hospitality, education, culture costs, right? That side of the inflation metric is also starting to come down, mainly due to the fact that labor costs are coming down, right? So we saw that dramatic jump in labor costs during that 2021 to 2020 or 2020 to 2021 timeframe, where you saw many people jumping ship, going to a new employer, getting paid an additional $10,000 or 10% more, and everyone was able to find a new job and get paid almost 10, 20% more for that same job. Obviously, things have changed pretty dramatically over the past few years, and that wage growth or labor cost has come down pretty dramatically, which is helping to lower the overall services inflation that we've been seeing, which is all good signs for us from a point of inflation costs and where we see the trajectory of inflation going over the next few years. So this is a good sign for us in an inflation metric. One thing I wanted to point out here, if we go to the next page, this is again going to exemplify how we are seeing the trend in inflation costs and that sticky services inflation that we did see from the end of 2023 to the beginning of 2024 jump up a little bit month by month, but the trend is again looking solid. One of the big areas that we talk to clients about is actually housing costs, right? And I'm sure we all know the housing market today is pretty chaotic and pretty crazy with the supply and demand constraints that we have. But one positive development that we are seeing is because of the supply side from a renting perspective for housing, the amount of new multifamily properties spouting up all across the country, we do see rent costs coming down and more subsiding over the remainder of this year going into 2025, which would be another positive development for inflation. The last chart I want to go through is kind of just our forecast in conjunction with LPL's data for the remainder of the year. The biggest things I'll focus on are real GDP, gross domestic production, right? You saw Q1, we had a positive gross domestic report of 1.3%. Q2 estimating about 2.2%. Q3 of this year expecting about 1.4%. And then Q4, we're looking at about 1%. And you'd say to me, as I can pretty much easily identify too, that is a declining growth rate as we suspect, but still positive for that matter. So while we do expect a slowdown in the economy abroad here domestically, we are still seeing a positive growth rate. We still continue to see a resilient consumer, albeit a lot focused on the lower interest rate environment and the housing costs being much more subdued. One thing I'll also point to is we are seeing an uptick in the unemployment rate getting above that 4% metric that we always like to focus in on. But this is not a clear sign of any type of recession impending recession or anything of that nature, as we have shown here in the past. We were seeing at a 5.4% recession rate unemployment rate in 2021, coming out of that pandemic-induced recession. But typically around the area of unemployment rate that we are in today is a very comfortable number for us. Again, other numbers that we're seeing are important on this chart are the CPI, PCE, core PCE. Those are the inflation numbers. Again, always all trending down towards the Fed's 2% target that we want to see. So overall, from an economic perspective, we do see a slowing growth economy here in the United States. We do see also deglobalization across the global aspects. We see more onshoring here in the United States, as well in Europe and other countries. But overall, from our perspective, we see a resilient consumer able to avoid potentially a recession that last year was something we thought would have been coming by now. So I'm going to turn it over to Ed. He's going to talk more about how this all intertwines with the stock market. Ed, take it away.
Okay, thanks, Anthony. So based on those economic conditions, gains on stocks may have been pulled forward. Next slide, please, Jen. And right now, the current bull market, which began on October 12th, 2022, has gained 52.8%. That may sound like a lot, but the historical average gain for a 2-year-old bull market is 60%. So based on this analysis, stocks may have a little bit more to run, but not a whole lot. Next slide, please, Jen. And, the Fed is in a pause currently, and the current Fed pause is at 331 days, which is the second longest in modern market history. Back in 2006 and 2007, the Fed actually had a 446-day pause. And what history has shown us is that the S&P 500 has risen during 5 of these 6 Fed pauses, interest rate raise, decrease pauses. There's been an average gain of about 13%. So during our current pause, stocks have increased about 20.5%. That's as of June 21st. So again, this may be a sign that stocks are nearing or fully valued. Next slide, please, Jen. Last December, corporate earnings had been in a little bit of a recession, but we think that the drags that healthcare and natural resources put on earnings growth is turning around, and valuations are really elevated. So it's important that as we go forward here, we see earnings increases. And LPL Research raised its S&P 500 earnings per share forecast for 24 and 25 to $240 and $260 respectively. So that represents an earnings growth of 10% in 2024 and 8% in 2025. So it's something to really pay attention to. But hopefully these earnings will grow into the stock valuations that we're seeing right now. Next slide, please, Jen. And also in looking at trying to predict what the stock market might do, I mentioned that I think I mentioned that the price earnings ratio right now is 21 compared to the long-term average of 16. And so when you do the inverse of that, and you look at the equity risk premium, we see that it has actually gone negative, and the equity risk premium takes earnings per share divided by the stock price minus the 10-year treasury rate. And you can see that recently, after for a long time it's been positive or at the average, it's gone negative. So these are things that we're considering, and at this point, we've decided that we are going to maintain our allocations to stocks, but we will not be overweighting our allocations to stocks in the upcoming 6 months. With that, I'll turn it over to Ted, and Ted's going to talk about the election, bonds, and commodities.
Good afternoon, everyone. It's good to see, it's good to hear from all of you. Glad you were able to participate with us today. The U.S. election is a distinguishing fact from opinion. Basically, what we want to give you today is some historical facts on what has actually occurred in the history of politics versus what the news media likes to profess. The first slide you're seeing here, stock performance based on congressional composition. As you know, the U.S. election is forthcoming with everyone preparing to do their voting this fall. Obviously, there's been a major political shift in the last few weeks. And obviously, we still have to see how this all pairs out. That being said, polls are very tight with the forecasters focusing on 6 key swing states, being Arizona, Georgia, Michigan, Nevada, Pennsylvania, Wisconsin, which could end up determining the actual election winner. While we won't know who will win this November, the market has been fairly impressive in calling election outcomes. Actually, since 1928, whenever the S&P was positive, for the preceding 3 months of leading up to the election, the incumbent party remained in control of the White House 80% of the time. In contrast, when the market is lower during the 3 months before the election, the incumbent party has lost the election 8 out of the last 9 times. When combined, the market performance has predicted 20 out of the last 24 elections. So suffice it to say, the market has been fairly accurate about 75 to 80% of the time. The other thing to keep in mind, too, is that we have 34 seats in the Senate upcoming for re-election, along with the entire House of Congress. This raises another popular question during election years. How do stocks actually perform under various election leadership compositions in Washington? And that's what this bar chart is illustrating for you. Like most elections, several scenarios could play out regarding the political configuration between the White House and Congress. And while we won't know that till Congress until November, the S&P has generated its best annual returns with a Democratic president and a Republican-controlled Congress. This is going back the last 74 years. However, the market has also posted strong annual returns with either a Democratic or Republican president, provided the Congress is divided. And you may have heard this many times in the news. A business looks at a divided Congress with the president is usually an opportunity for the stalemate with not many things happening in Washington. Next slide. What happens in Washington can play an important role in our daily lives and help to shape the economy, but politics alone do not exclusively drive the market or the economic cycle. There are other more important macro forces that basically will affect the economic expansion or contraction of the American consumer and corporate America. For the long-term investor, and that's what we're really talking about today, is long-term investing. We're not trying to do market timing, But for the long-term investor, as this graph illustrates, someone who had invested $100,000 in the S&P back in 1950, if they only kept their money in the market during their preferred political party in power in the White House, they would have had $3 million if they were invested during Democratic presidencies, ex-dividends, and/or $1 million if they invested only in Republican presidencies. While this appears very attractive, it far and away lacks what actually happened for the investor who ignored all the political noise and just stayed fully invested for the full 70+ year period. As you can see, that investor would have accumulated about $32 million over that 70-year period. So sometimes it's better to put the TV on mute. Just a little paraphrase that I'll mention there. Next slide. Now we're going to talk about bonds. And as you know, bonds are inverse to stocks traditionally, with the exception of 2023, where there was a, 2022, where there was a first time in 75 years where there was a correction in both the bond and the stock market. Bonds are usually intended to provide income. Next slide. Current market pricing suggests that the Fed will only take the fund Fed's rate to around 4% or so before stopping its rate cutting campaign. Absent an economy that slows more than that, we expect the 4% funds rate will keep longer maturities from falling meaningfully from the current levels. As we've seen through the years, market pricing for the Fed's reaction has been volatile, and this rate is no exception. That said, we do expect the 10-year Treasury to somewhere be between 3.75 and 4.25 by year end. We don't expect the Feds to achieve their 2% Fed target rate for inflation by the year end, but obviously that's still a long-term objective of the Fed. Next. Another interesting fact that is somewhat misunderstood. Many financial markets have always assumed that bonds had substantial appreciation over the 40-year bond bull market when we had that from 1981 through 2017. Traditionally, stocks, your total return from a stock is made from appreciation over time. However, with bonds, it's actually the reverse of appreciation. What has really been learned over that 40-year time cycle is only 25% of the total return was actually a result of the bond appreciation. The majority of the return was completely attributable to the interest coupons that were paid out over that 40-year period. So with interest rates being at a fairly attractive level, again, this may be a worthwhile consideration to, if you're keeping a lot in cash, to consider bonds as an alternative holding place. Next. Speaking of cash and bonds, basically what we're showing you here is bonds tend to outperform cash over time. So what we're showing you here is the trailing 5-year annualized return for total returns for bonds versus cash. To kind of compress this slide a little bit, bonds over the last 40 years have averaged 6.4% versus cash, which has averaged 4.1%, which is about 1.5 times or 1.5% greater returns over that per year over that annualized period. Matter of fact, over the last 434 months, bonds have had a better 5-year return in all but 11 periods. That is 97% success rate. As you may know, presently, there's about 5.6 trillion in cash. As a matter of fact, yesterday, the Treasury had a major auction, and for the first time this year, the majority of the Treasury sale was consumed by retail investors, not institutions. They ended up buying about 85% of the total bond auction for yesterday. So a lot of institutional investors that have cash on the sidelines, along with other investors, may be realizing that interest rates are going to be coming down, and this may be a good time to lock in those bond rates. Next slide, please. As you will know, if you work with our firm, in portfolio management, we always strive on diversified portfolios, and we'll get into that a little deeper in a few slides. One of the areas that we talk about diversification is alternative investments. The market has been fairly calm this first half of the year. In 2024, we've only seen mild volatility year to date. As a matter of fact, this slide is obviously a very, very busy slide, but basically what it's looking at is the change in federal rates for the major money center banks of the world and their volatility relative to opportunities in other markets of the world. What we're suggesting is that we expect volatility to increase in the second half of 2024, notwithstanding the elections in the fall, but other issues that may be forthcoming. With that being said, we try to encourage our clients to consider non-traditional investments as part of their portfolio. Non-traditional investments would include private equity, private credit, hedge funds, global macro. There's a number of various long, short, many different types of alternative investments that can further strengthen the portfolio, especially against downside risk. So we would encourage that even the emerging markets economy, which has really disintegrated itself over the last 3 years, there's great opportunity in certain foreign markets at this time. Next. We also want to talk about, get a little further into some of the areas of alternative investments. One that's had a lot of commentary this year is the area of private credit. Private credit and infrastructure strategies are basically performing very well. As a matter of fact, this chart is illustrating that the default rate for private credit over the last 3 years is less than 1.5%. Historically, one of the institutions that we work with, who's been in the private credit arena since 2004, has had an average default rate of under 0.5% over that 20-year period. Private credit can provide you an alternative income stream very attractively in the IRA market. Also, private equity can give you the opportunity to participate in a very large swath of private companies in the United States that are obviously not available to us in the daily trading markets. Also mindful of the stress of keeping sufficient.
You have a scheduled activity.
Keeping sufficient high quality yields on loans that private credit uses. Private credit generally will only have senior subordinated debt as their majority of their asset base. That usually represents anywhere from 91 to 95% of their portfolio. They also structure their private credit debt to have floating rates. So as interest rates increase, their participation in that private credit, the rate that they're receiving is obviously adjusted upward. Again, we would look at this as an opportunity to further diversify portfolios, and again, encourage you to consider that going forward. One of the last things we'll talk about briefly is our commodities. Next slide. On the next slide, we're going to look at industrial metals, which continue their recovery, specifically copper. At this point, copper, as you well know, basically consumes almost every piece of equipment within electric vehicles. Suffice it to say, the demand for electric vehicles is slowly increasing, both domestically and globally. So the demand for copper will continue to increase over time. Also, the other metals that are a natural ingredient to the grid, which include copper and other metals, are going to be an incredibly increasing demand for the economies of the world. So again, we would suggest to you looking at both infrastructure build-out opportunities in this segment, along with opportunities in specific sectors of the commodity markets. Lastly, next slide. Lastly, we're going to talk about the strong dollar. As you probably know, the strong dollar has basically prevailed over this for quite some time here. the dollar has basically been a beneficiary for the Fed's higher for longer monetary stance as compared to their peers. The European Central Bank lowered interest rates, which in turn lowered the euro against the dollar. While the Bank of Canada also lowered rates, helping to underpin the higher dollar. The Bank of England also is expected to lower their rates going forward. We don't expect a severe change in interest rate policy in the United States, as we indicated before. We expect Fed rates to be somewhere between 3.75 and 4.25 by year end, which is still going to be an attractive alternative for foreign currency coming to the United States. Another way to look at this too is if you're planning to do any overseas travel, you may want to consider it now because the dollar is buying more goods overseas with a stronger dollar. At this point, we're going to close the general session, but I'd like to just make a few more closing comments. And obviously, if you have questions, we can open it up to questions. I just want to summarize our conversation today by recommending that you always keep a well-diversified portfolio, inclusive of various multiple types of asset classes outside of traditional stocks and bonds that are domestic owned. I would encourage you to consider emerging markets, foreign markets, also, as I said, private credits, alternatives, and other instruments that basically can help mitigate risk. As all of our clients know, one of the portfolio replanning reports that we provide them is a report that assesses the portfolio risk on any point in time in their portfolios. So understanding how your portfolio is invested long-term and diversified and how much risk can take can help you better solidify long-term performance over time. With that, I'll turn it back to Jennifer, who can open it up to questions if there are any. Jen?
Thank you, Ted. As Ted mentioned, we're going to open it up for questions now. So any of our attendees who do have a question, you can use the Q&A on your Zoom control bar to enter your questions. And of course, for our other advisors on the call, if you have a question or a comment based on someone else's section, feel free to throw those in there as well. We have one here. Are there any regulatory changes or policy updates that could impact financial planning strategies at the end of this year?
I think regulatory policy changes that may be forthcoming are probably going to be deferred till the election and the new administration and Congress is in place. That being said, there may be some Department of Labor regulations that are forthcoming relative to the qualified plan area that has changed relative to the investment, basically the investment advisor world, not to the average individual investor. I can't speak to anything relative to the environmental, the EPA, or anything like that. That's not, quite frankly, in my wheelhouse. So I don't know of anything myself. Ed, Anthony?
And the other thing that's going to be coming up is whether the tax law changes will be renewed or whether we'll go back to the pre-2017 tax rates and inheritance tax rates and all that. So that's going to be a big deal for, like you said, the new president and the new Congress to deal with.
Yeah, that will grandfather. That law expires the end of 2025, but they'll obviously have to address it long before 2025 is the end of that calendar year.
Yeah, I think the biggest things I've been bringing up to clients, any changes obviously is that the tax law changes that may come to fruition, but obviously expect probably more changes before 2025. Talking to clients a lot about that. I think one thing that's finally gotten clarity, this might be more unique, but if you have an inherited IRA, you received an inheritance, and are a beneficiary of an IRA in an inheritance, there are a lot of changes that have been made, extremely confusing, unfortunately, over the past few years to get that clarity. That clarity has finally come. So obviously with our clients, we always, have a plan in place for any of those accounts. But if you are new to an inherited IRA, You definitely want to make sure you have a plan in place for that because there are some changes to those types of accounts and distributions from them. But aside from that, I think you brought up the qualified plans, small employers. I think there's some changes there. I think we also saw some major changes for 529s, doing the Roth conversion. That's a new feature that just started this year. But obviously everything is personalized when we work with our clients. So there may be other planning strategies that have changed that we would, of course, bring up to you. But if you have things that you're worried about, of course, obviously reach out to us as well.
Our second question here, which sectors might be most affected by the changes in the administration or policies? Are there particular sectors that you're keeping your eye on this fall?
I'll take a first stab at it. I'm interested in the other advisors' opinions. I mean, I think, I think it was yesterday, honestly. I was on an institutional web call about this exact conversation, right? And, it's reminiscent back to like the Trump trade is what we wanted to call it. And everyone, got in when Trump originally got elected. Well, number one, it was, the stock market's going to crash. Trump's in office. Complete opposite happened, but it was more so on the sectors that are anticipated to do well, which if you look at it today, I think a lot of people would say the sectors that would do well potentially under Trump would be, energy, industrials, the onshoring impact. Whereas maybe if you go to the Democrat side or with Harris here, if we think tech, would probably continue to do well. The EV market, right? The Inflation Reduction Act that's happened there. But all in all, as we stress to our clients, we don't make dramatic moves just based on who's in office, because at the end of the day, those Trump trades, if we will, unraveled pretty quickly. The market did a lot better than many thought. And the sectors that people thought would be unloved were still loved in that respect. And as my dad already mentioned, it doesn't really matter who's in office, the market, will do what it wants, I think at the end of the day. But I'll turn it over to the other advisors if they have any other own opinions.
Anthony, I think you hit it. Energy and industrials, I think, could be the best beneficiaries. So,
I just expand on that energy issue. One more thing. When the current administration came in, their policy was that they were going to shut down carbon fuel over the next 10 to 15 years. As you probably know, we're producing now more oil daily than we've ever produced in the United States. So, and that's without the ability to open up a lot of federal drilling lands that were theoretically closed for long term. So, sometimes the political noise isn't accurately going to be reflected in policy or in how it's transferred to economic reality. I think, again, you have to look at, we have a $27 trillion economy. You can't slow a $27 trillion economy down very easily. You have 350 million US population, and you have 8 billion global population. The demand for products and services around the world are going to continue to grow. So I think our economy is going to continue to improve. There's going to be volatility no matter who's in powers to be in Washington. It's just a matter of, I think, whether our policies are more favorable for business and the consumer, or whether they're less favorable for business and consumers.
Thank you, everyone. I don't see any further questions, so I believe that has wrapped us up for the day. I will say thank you to Ted, Ed, and Anthony for sharing your insight today. To our attendees, we appreciate your time. Again, we will follow up with the recording of the event. If you didn't get to your questions, or there's something that you wanted to discuss with your advisor personally, please reach out to us. We always want to talk about how these topics affect your financial plan. So thank you, everyone, and have a great day.